The news today, central banks say no tapering, but markets are not buying it. So reading further, central bankers worldwide have been unequivocal. They have the same. There are no plans to cut back on money printing anytime soon, let alone raise interest rates. So they will print money. They print. So if there's a lot of supply of money, there is inflation. So markets do not seem to be buying it. US 10-year Treasury yields rose on Wednesday to one-year highs above 1.4%. 1.4%. That's the yield for US 10-year Treasury, extending this year's near 50 basis point jump that has dragged up sovereign borrowing costs in Europe, Japan, and elsewhere. Yields retreated later in the session to 1.37%. The reckoning is that the spending step up by US President Joseph R. Biden's administration and post-vaccine economic reopening will fuel global growth. So, as the US spend, of course, they have to import products from abroad. So that will fuel global growth. And an inflation rebound. However, there will be a high demand. So that printing of money, there's a lot of money around. So the cost of goods will now go up. Then there's inflation, forcing central banks to taper or withdraw stimulus ahead of schedule. So a brighter outlook may indeed justify higher yields. But what has started to spook markets is a sudden move up in so-called real yields or returns in excess of inflation. What is the real value of your money? Because, of course, when there's a lot of money around, there's an inflation, there's a lot of supply. So that's an opportunity to have a chance to get some of those money, a lot of money that's being printed around. That shift can tighten financial conditions, suck cash from stock markets in general, hamper the recovery. So since there are higher yields in bonds, in treasury, those are investing in the stock market will put their money in the bonds. But for us, we stick to our assessment. We stick to the stock market because our dividend yield is higher. We get a higher yield from the stock market. Specifically, SPC Power Corporation, the company that we own, give us 10% or even 14% in dividend yield compared to the 1.4% in bonds. So it is spooking policymakers too. Reading further, central bankers have weighed in this week to stress policy will remain loose for some time. But the mantra seems to be falling on deaf ears. US Federal Reserve Chair Jerome Powell knocked yields just a couple of basis points lower after commenting that the inflation target was more than 3 years away. So they have made their policy, the monetary policy, they print money, and they targeted inflation 3 years ahead. Eurozone yields only briefly heeded European Central Bank Chief Christine Lagarde's warning on Monday that the bank was closely monitoring the recent rise in yields. The reason, according to ING Bank, is that markets are pricing with an increasing degree of conviction, the end of ultra-easy policies. You know, countries are interrelated. We are the monetary policy of the US and Europe will affect the value of Philippine peso. So if there's inflation in those large economy, it will affect our local inflation too, because the value of peso will shrink because the value of dollar and the value of the euro is higher than peso. So the dollar, what the dollar can buy, the peso will surely need more peso to buy more. So if products globally will go up or inflate or there's inflation globally, the value of the peso will also be less. So that's how they will affect locally. Markets heard, so reading part here. Money markets show investors expect a federal rate rise next year. Some bet on an even earlier move. Euro-dollar futures suggest a roughly 64% chance of a 25 basis point rate hike by the end of 2022. A week ago, it was seen at 52%. Markets heard central bankers saying, "Stop it, markets, you are going too far," but they are worrying central banks might change their mind as new data emerges, said April LaRouche, head of fixed income investment specialist at Insight Investment. If travel, dining out, and shopping fully resume in coming months, it could unleash trillions of dollars in pent-up saving worldwide. Just in the United States, personal savings totaled 2.38 trillion at a seasonally adjusted annual rate in December, higher than at any time before the pandemic. So, due to the pandemic, the people have saved because they're not going out. So instead of spending those money, they save it. So us, instead of saving it, we invested it in the stock market. So because to earn more higher yields rather than what the interest rate we earn from the banks, or instead of investing it in the bonds, retail treasury bonds or bonds, treasury bonds, which also only gives 1.1% interest rate or 2%. So, reading further, the steeper yield curve is a reflection of the fact that we're seeing these green shoots in terms of economic stats. Comfort that the vaccine is kicking in, said Anders Persson, Chief Investment Officer of Global Fixed Income at Nuveen. So, stock market is a better investment option because you not only have a fixed income from dividends, but the company, the shares that you're holding for the company also appreciates. So you earn in two ways. So reading further. Some investors are betting that the rise in yields will prompt the Fed to act, but not by tightening policy. I do feel that some form of yield curve control is on the cards. Reason being inflation will likely not be sustained. We will see a pop as we emerge from the COVID crisis, but it will not be permanent, said Nick Marostus, head of global bonds at Janus Henderson. The Fed discussed the possibility of reweighting its bond purchases toward the long end of the curve at its November and December meetings. While the bank chose not to act then, yield curve control, which was used in the wake of the 2007 to 2009 financial crisis, remains an option. Elsewhere, the picture is similar elsewhere. In New Zealand, warnings of downside risk to the economy by Reserve Bank of New Zealand Governor Adrian Orr contrasted with buoyant data. Bond yields shrugged off his comments to hit 11-month highs. while overnight index swaps began pricing in the possibility of an end 2021 rate hike. There is, of course, the possibility that the pledges to keep policy ultra loose in the face of recovering growth only fund inflation expectation further. So there's a risk of inflation. Inflation is real. So could markets force central banks to act rather than just jawboning? Here, the Fed faces less of a dilemma than its peers. Japan's 10-year yields are near the highest since late 2018 at 0.12%. So that's the highest they can keep. The yields from bonds, 0.12% compared to our investment portfolio. We earn 8 to 14% from SPC Power Corporation. Credibility issues for a central bank that aims to hold yields around 0%. The ECB too may have to step up bond purchases under its emergency asset purchase program to combat rising yields. At the moment, it is a tension between markets and central banks rather than a conflict, said Jacob Nell, head of European economics at Morgan Stanley. The attitude of the Fed is that if markets think growth is stronger than we do, then that's fine. It will help growth and inflation expectation. So the Fed won't fight the market. It just doesn't believe it. Okay, guys? So join me as I go to the grocery, to the supermarket, to buy our supply, our food.
LSD 35 locomotives, Telika 75 locomotives. crocodile 3810, 32 GMT 32 energy 75
Thank you.